Welcome everybody to our divorce class and how it affects financing with Jolene Moore. I'm Cindy Bishop with Cindy Bishop Worldwide, and I would like to talk about Jolene for a minute. First of all, this is a very important topic for us because it really anchors what we probably don't know and then helping us bring us to the accuracy of what Jolene's going to teach us, because she always gives us such unbelievable information. Our speaker, Jolene Moore, is fabulous, and she's just got an abundance of experience, relevant knowledge in the real estate lending field, and finance is just her thing. She is a top producing lender nationwide. She's also the vice president and senior home loan consultant with Main Street Home Loans. She's very respected. She does some of our financing classes that actually help you with personal finance. She does a lot of business building training. She's just amazing. I love what she teaches because it impacts you guys so richly. So with no further ado, Jolene, take it away.
Thanks, Cindy. So I'd asked Cindy if it was okay, and I just wanted to mention, hopefully you guys have seen, if you're on my video list, that we are hosting a lunch and learn tomorrow here in my office. It's my first face-to-face since COVID, so I'm excited. So it's a panel of presenters we have. So we have one of our top underwriters, a title person from National Settlement Services, a social media person, and then also a top producing agent, Tracy Barrett from Century 21. So just to try and give you guys different tools of how each of them can help you in the current market. So we have lunch and some goodies and stuff as well. So if you're interested in attending, let me know and we can send you the link for the e-bite. So today we're going to talk about divorce. So the divorce and basically how it impacts on home financing. So there's various different aspects of it that can impact their ability to qualify to purchase a home, either because of liabilities that are associated with the divorce or if there's income that they're receiving as well. So I'm going to touch on each of those things. If you guys, like Cindy said, I love interaction. So if you want to ask a question, you can unmute yourself, ask the question, or put it in the chat. I do have it open. Feel free to put any questions you have there as well. All right, so move this, I think it blocks. So resources for clients going through a divorce. So in the past, pre-COVID, I volunteered for the Second Saturday workshop. So it's obviously, as it says, it happens on the second Saturday. It's done through different, that's an organization that's called Second Saturday. And then most of the time it's a divorce, like a firm that is a family law firm that helps coordinate the workshop. So usually it includes an attorney, a family law attorney, a lender, a realtor, a financial advisor, and a counselor. So it was we'd meet for a couple hours, 2 or 3 hours on a Saturday, the second Saturday, usually it was at a hotel down in Alexandria when I did it. And it basically, I think the attendees, was like $25 is what it cost at the time. I think they also went virtual with it for a while also. But it basically allowed anyone, it was, I think, geared towards women. So it was basically allowed you to come to the workshop to ask any questions, but I don't know if it's limited to women. So you can definitely look at their website and see what's available, but it basically allowed individuals to come to be able to learn more about, the legal side of things, the finance side, the financial of their, any assets they have, as well as, obviously mental health is a big part of divorce. So it's kind of helping work through all of those different aspects. A financial advisor, I went through a divorce myself personally, maybe 15, 16 years ago. So having a financial advisor that you guys, have a connection and a relationship with, I think can be very helpful in this situation as well. So when you meet a client that has, that is, starting to go through this process, that you have the ability to have a resource for them. And that's what this is kind of list is intended, is that you want to have these relationships and these connections so that if you have a client that is going through this, that you have, the knowledge to be able to refer them to the resources they need. So financial advisor, obviously divorce attorney is going to be a big part of it, might be a mediator, because I know those are very popular right now as well. And so there's a lot of different opportunities that you can find to help them. Counselor, like we talked about, and then obviously the lending. So making sure that you have, those resources available to clients. Second Saturday is, and when you ask for the website, Shinchen, that's just Google Second Saturday and it will give you, it'll take you to the information. So when I have a client that has reached out to me that's, looking at, telling me that they're going through a divorce, the first question that I'm going to normally ask them is there any property settlement agreement? And, that would be, that obviously in Virginia, we don't have an official legal separation, but there's a good amount of couples that create a separation agreement that outlines, like, if there's children, what's, the custody, is there child support being paid by either party? Is there alimony being paid by other party? Is there a marital home? And if so, with that marital home, what are the intentions for that marital home? Is one spouse buying out the other? Are they planning to sell it? And so for you and for me, that's one of the first conversations that you want to have, because it gives you a lot of details about how you might be able to help them. Because obviously, if it's a situation where their plans are for one spouse to buy out the other spouse, then you could connect them with a lender who could help them. And I'll walk through some of that as well and what that looks like. But then also, what's the other spouse's plan? Are they going to be buying, or are they wanting to rent? What are they going to do if the other party is going to be buying them out? Or, are they planning to sell the home? And then what are the other two parties doing at that point in time? Are they going to buy, or are they going to rent? So it's, that could be 3 transactions, it could be 1, but that's knowing, once you know what the plans are for the marital home, and if they've already come to an agreement on it, having that separation agreement is going to help you be able to know exactly where things stand. The thing that's important for me too is about if one spouse is going to be buying them out, in that separation agreement, oftentimes it will say either a dollar amount of what's owed to the other party, or if it's a percentage, whatever that might be. And that helps me with looking at doing a refinance for them to be able to buy out the other party. And we'll get into that a little bit more. And if the divorce has actually been finalized, so they have the separation agreement, but they actually have now gone, and it's completed and they have the divorce decree, we're going to ask for that as well. And the reason I ask you this too is, like, for instance, like tell you this, I'm sorry, is we get the other day, I got an application of someone that wants to get pre-approved to purchase a home, and they indicated that they're paying child support. The minute I see child support, that means, okay, I need to ask for a separation agreement or a divorce decree, because that's exactly what the underwriter is going to see and ask for. Because again, what we're looking at is there other liabilities, other debts, any other expenses or responsibilities that party has based on leaving that marriage, and we need to make sure that we've addressed it and identified it. And the good thing is that in this agreement, and if the separation agreement outlines that another party, like one of the spouses is responsible for, let's say, a car payment, and it's a joint account, but the husband is the one that's going to be responsible for the car payment. When I go to qualify, let's say the wife, if that divorce decree has been court ordered now that says the husband is responsible for that car payment, we then don't have to count that debt against the wife for qualifying for a new house. And it would be vice versa as well. So whatever party is identified in that document that is now holding responsibility for that debt, then we potentially have the ability to not have to count that debt against them for qualifying for a new house. And the same thing with a mortgage. Now with the mortgage, it's usually a little bit different, and in the sense that normally we have to get 12 months canceled checks. Or 12 months bank statement, something that shows that, or it's been court ordered. So there's a couple different choices there. If they've been separated for a while, let's say, and one of the, spouses have been paying the mortgage payment for 12 months, and the other one had moved out, and it has been finalized, so the divorce isn't final, we could still potentially not have to count that mortgage payment against the person that's moved out if we document that the other spouse has been making that payment for 12 months. So there's different ways that we kind of try to work and get creative, in the sense that we're going to help those clients be as successful as possible in looking at purchasing a new home, and, at the price range that they want to obtain. All right, regarding child support and alimony. So, it can definitely be used as income, right? So with both of those, with child support and alimony, we have to document that the person receiving it has been receiving it for at least 6 months. And we have to be able to do that either through canceled checks or again, bank statements. The preference is if the child support's $1,100, they get $1,100 every month. If there's a variance where 1 month they get 1,000, another month they get 1,200, we may be able to get just a letter of explanation stating why there's a variance, like if there's other expenses that, one party was responsible for, and so they just deducted it from the child support, whatever it may be, we can work through that, but we do have to see consistently that they've been receiving it for 6 months. This is all relative to Fannie Mae, Freddie Mac, conventional FHA, VA loans. We do have one investor that I've recently did a transaction with where they were going to allow us to use the alimony when we had less than 6 months, but that's going to be a unique situation. They had a significant amount to put down. They had reserves after, so we were able to, work that in an outside the box scenario besides Fannie and Freddie. So if you have anyone in that situation, always have them reach out to me because we'll see what we can do. But that for a traditional, conventional Fannie Mae and Freddie Mac loan, that's what these guidelines are related to. So we have to show that they've been receiving it 6 months and needs to be consistent. So 6 months in a row. And it also has to be documented by that divorce decree or separation agreement that they're going to be receiving it for at least 3 more years. So if child support, let's say there's a child that's going to be turning 18 in 2 years, then we can't use that child support because it's ending before the 3-year period. But let's say they're turning 18, but they're only a freshman in high school. So they really still have 3 more years of high school to complete. Then if we got a copy of the transcript, we could show what grade they're in, and we could still potentially, be able to use the child support because we've documented that, if the agreement said 18 years or finishing school, high school, then we'd be able to use that because there would be a 3-year continuance still available. So again, we're going to do whatever we can to try and help that client use whatever income we need, to make them successful. If they have no separation agreement, so let's say that they kind of just did it on their own. It was an amicable situation. One party has been paying the other party, child support or alimony for a 6-month period, but they don't have an official separation agreement and they aren't officially divorced. If we get something written by both parties and signed, and it usually requires to be notarized just because the underwriters want to verify that it actually is the 2 parties that are signing the document that basically says, this is the agreement. I'm going to be paying this amount to this person for this period of time, and that there's no other financial obligations. We can be able to use that and still be able to use the income, for the child support and alimony to be able to qualify. If it's being paid, so if another spouse is paying it, on the flip side, we also have to use it as a debt. So like I was saying, we got an application earlier this week and it showed one of the parties paying child support. So we have to count the child support as a monthly obligation. So it's part of their monthly debt to income ratios. But then we also have to get, like I mentioned, the divorce decree or separation agreement, something that's indicating if there are any other liabilities that this party has based on a previous relationship. Now, just because someone's paying child support doesn't mean they're always married. So again, we're going to be able to ask that question and figure it out. But if they were, then we're going to look to get the documents that we need to show the underwriter that there is no other financial obligation besides the child support that we are showing on the application. Anyone have any questions so far? Any thoughts or? Alrighty. So like I mentioned, I love questions. So anything you can think of, any scenario, whatever it may be, I'm happy to talk about it. Something to keep in mind, child support isn't taxable if you receive it, alimony is. Child support isn't tax deductible if you pay it, alimony is. So those are just FYIs. Marital home. So if one spouse wants to buy out another spouse, and like I mentioned, it's in the separation agreement, what we can then do is it's called a rate and term refinance. And what that means is there's basically 2 types of refinancing in the lender world. There is a cash out refinance and a rate and term refinance. Rate and term means that you are just, whatever the balance is on the loan, you're paying that amount off and rolling in any closing costs. and you're not taking any equity out of the house. And that's going to be the best interest rate, the most flexibility on the loan to value, all of that. It's the most ideal situation when you're looking at refinancing. A cash out refinance means you're taking equity out of the home. It's going to be a higher interest rate, and it's limited to 80% loan to value. The benefit that Fannie Mae and Freddie Mac have put into place for for borrowers who are going through a divorce and buying out a spouse, that's on the loan currently, is they will allow that to be considered a rate and term refinance. Again, as long as we have something that spells that out in the separation or settlement agreement that indicates that this party is buying out the other party, removing them from the loan, and it's all due to a divorce. And again, we normally need to see what percentages that or dollar amount that they're going to be paying the other spouse, so that again it meets that guideline of Fannie and Freddie that allows us to do in rate and term, because we have to document how much is due to the other spouse when you're buying them out. So I had a situation recently where we had a borrower that we were refinancing to take off the other spouse. $36,000 was owed to the spouse to buy him out per the agreement. With the first loan, we were only going to be able to get up out like 16,000 because it changed the interest rate and there's all kinds of things involved. But basically, we could only get 16,000 out. Our underwriter said we have to pay all of the 36,000 in order for us to not consider it a rate and term. We can't just pay partial. So then we did a second loan, a home equity line of credit, to get the additional 20,000, so that at the end of that refinance, we were able to take out the full 36,000, give it to the other party, and again, still be considered a rate and term refinance. So that's something, again, we're always working to figure out how to make this work for the client and put him in the best financial position after that. Did someone have a question?
Hi, Jolene. Yes, this is Simone Isaac. I have actually a scenario, if
Sure.
you could help out with it, pertaining to marital home. So have military spouse, home is a VA loan. They're getting ready to have a divorce. The other spouse cannot would not be eligible for a VA loan because they've never served in the military.
Mhm.
So how will it work if the home, the loan, and the deed is in the military spouse's name, and the military spouse wants to sell the home?
So the other spouse is not on the deed or on the loan at all?
No.
That would become a lawyer situation, because unfortunately, there's nothing legally that's, related to the mortgage or to the deed of the home that prevents them from doing that. So then it would probably become down to the legalities of it, meaning like, did they buy it while they were married? Is it an official marital property, even though, legally the other spouse is not on it? So I would definitely reach out to an attorney to find out what rights that spouse might have due to the fact they're not on the deed or on the mortgage.
The other spouse has never paid the mortgage. It's been all the military member who has paid the mortgage the entire time.
But was the house obtained while they were married?
I think it was bought while they were married.
So I still think that there's a potential that it could be considered marital property, because even if the military spouse paid it, I mean, I don't know all the specifics, but if there was the other spouse stayed home with children or stayed home for whatever various reason might, and they became to an agreement that, this other spouse is going to be the one that was making the payments. Again, I think that would be a discussion for an attorney to find out all of the specifics involved in the situation to get their opinion of what rights they might have.
Okay, thank you.
Okay, sure. All right.
I got a question, Jolene. This is Benita. How are you?
I'm good. How are you? Good.
Very interesting topic, so thank you.
Sure.
On that same line, if a couple is separating and they're moving out, the divorce, of course, isn't final, but one wants to buy a home, would that be considered marital property?
So again, I don't want to go into giving any legal advice, so I'd always recommend talking to a attorney What I will say from my side of things, I've had many clients do that without it being an issue, where they are separated and they've bought another home and it wasn't considered marital property. But again, I don't know all legalities of it and the specifics of what might have occurred behind the scenes that I may not have been aware of. But if there's like an official separation date, I think that's going to be what it might come down to. But I would definitely have them talk to an attorney.
Okay, thank you.
Uh-huh. Okay, so we already talked about if one spouse has been paying, the 12 months, that we're not being able to, being able to not have to count that payment. And then also regarding capital gains, that's something I get a question about often outside of the divorce situation, but just in general of, when do I have to pay capital gains? So, you definitely wanting to consult a CPA regarding that. The CPA that I work with has told me that as a married couple, you are exempt up to $500,000 for capital gains. And as an individual, it'd be 250. So again, that could be important for your client to determine if they're going to sell it, it either while they're married, or if one was going to sell it later and take it over and then sell it down the road. What impact would that have? Is it better to sell it now based on gains they have and do it as a married couple? Or is it going to, hurt them down the road if one of them takes over the property and then wants to sell it later and now might be subject to capital gains? So those are things to think, to keep in mind and think about as well. And like I said, obviously to talk to a CPA about so that they can have all of the education and guidance they need to make that decision. And then, this kind of goes to Simone's question, but in a different sense, in the sense that like, if that, spouse wants to go and buy now, since they were never on the loan or the title, they would be considered a first-time home buyer if they haven't owned a home in 3 years. So if they've never been on the title or on the loan in the past 3 years, then they would be available, like if there's any first-time home buyer programs that they want to take advantage of. So just something to keep in mind as well. All right, so when listing the marital home, I, in the past, have also done a workshops with another realtor who was a family law attorney and then switched and became a realtor. So her and I did some continuing education classes for family law attorneys. So this was some of the information she included in the presentation that her and I did together. So I thought I'd just share that as well. So educate them, on writing the separation agreement. So if you do meet with the clients and they're in the process of just thinking about it, right? They're thinking about what do they want to do? How are they going to move forward? They haven't come up with an agreement yet. These are some things about you can, you can talk to them about that they can consider when they're writing the agreement. Now, obviously, the market that we're in currently, some of these are not going to be as relevant as they might in other markets. So this can be an education for you, just in the long term, not necessarily right immediately now. But, price adjustments, when we have a market where when you list, you may not get an offer right away. Making sure that there's an agreement to the timing and percentage if they do have to make any price adjustments, so that it's not something that you're constantly having to have them potentially bicker over or have challenges with, that they've kind of come to that agreement prior to the listing, can help you be successful. Accepting offers. Again, not outside the current market they're in, but talking about what is a reasonable offer for them. If you get an offer that's, within 3 to 5% of the list price, are you agreeing that you will accept that offer? So again, just having those conversations about what they consider to be an acceptable offer. And it might be now, if there is a contingency left in place, or, they're closing in a certain time period, having some of those conversations about timing and contingencies and things like that. And then repairs, also addressing with them, obviously when you all meet with a client, you're going to talk about what may need to be done to the listing before you list it. But also if they're not, willing to make any of those changes or adjustments, how much are they willing to potentially give a credit for? And again, down the road, not necessarily in the current market, but what are those sharing of those costs going to look like to either get the house ready for sale, or, any repairs or credits whenever we do have home inspection contingencies in place again. So these are, again, just conversations that can help you, be successful when you're working with clients that are going through a divorce. The other thing that I always recommend to clients when they're looking at figuring out the value of their home is to do a CMA with you all. You know, because the reality is if they pay for an appraisal, it's a cost that they're having to pay for. And if they decide that one of the spouses is planning to keep the home, we're not able to use that appraisal. So the appraisal has to be done by the lender. We have to order the appraisal and we have to do it through us. So they're potentially going to be paying, you know, two different expenses if they want to get an appraisal, and, you know, for the process of creating the agreement. But then if one party decides they're going to keep the house too, then they're going to pay for another appraisal. So getting a CMA through all of you can definitely help save them money. And I think also be, you know, obviously you guys are very good at what you do and help them be able to determine a value of what they could potentially sell for. Now, something that I do talk to clients about when one party is going to be buying out the other is taken into consideration. There's two ways of people doing it is either one, taking into consideration the closing costs they're going to pay for part of the refinance and splitting that. That's what I had one of my clients do recently, where basically each party was responsible for 50% of the closing costs. So when we had to pay out the other spouse, we deducted that 50% of the closing costs to them. The other way I think makes sense is if they were selling the home, they would be paying real estate commission, right? So with the party that's buying out the other spouse, I think should take that into consideration when they're looking at how much they would be paying the other party. Because if they were selling it, that party would only get based on, you know, after real estate commission has been paid as well as closing costs. So taking into consideration all the expense associated with selling the home, you know, versus keeping it, I think needs to be taken into consideration. And those are conversations I have with the client when they're starting, you know, the process and haven't come to me already knowing, okay, here's what I owe my spouse. But if they're asking me for thoughts and recommendations, that's what I usually go over with them. So again, I want to help you guys, you know, educate them as well on what they need to keep in mind to make sure it's fair to all parties, you know, as part of the transaction. Credit, you know, I've been doing this for almost 19 years, and I will say one of the things that I think that I think it's gotten better over the past few years. I think people have gotten a little bit smarter about it and maybe not letting some of the anger and things like that impact their thoughts of keeping their credit in good shape. But it's one of the things that I've seen have such a huge impact on their ability to purchase. You know, obviously, you know, it impacts their ability to rent. You know, credit is something that impacts us in so many different ways. And it's really a huge positive and a motivator to keep that in good standing for them, because there's so many things that it impacts. So obviously, as you all know, you know, one of the first things we look at when we're looking at pre-approving somebody is what is their credit score. So the credit score is going to impact the interest rate, what program they can do, how much there's mortgage insurance involved, you know, so many different things is going to be impacted by the credit score. So the thing, again, I recommend to clients is separating their liabilities as soon as possible. So if there is, you know, joint debt, mortgage, credit cards, car loans, you know, anything like that, anything that they can get into their own name that's going to be theirs, that they work to do that right away. But also just to make sure that they have a conversation and that they're not reliant on the other party to make the payment. And that if they don't feel confident that that party is going to be making the payments, that they continue to make the payments themselves. Obviously, I know that can be challenging and depending on financial situations and all of that. But, you know, it's about not letting the anger and the pride and the assumption that somebody else is going to be paying it, because that is when I've seen some, you know, when you have one late payment on a credit report, it can drop your points 50 to 100 points. So your credit score can go, you know, from 750 to 650 like that, you know, so easily. And it could be just one late payment. So again, just making sure that, you know, if you have this conversation with them early on, just helping them understand the importance of making sure that they keep their credit in good standing. The other thing that we do with clients, you know, when we do look at getting someone pre-approved is we do look at the credit score, obviously. And when we run the credit report, it tells us, let's say the credit's 700. Right below that on our report, it tells us how much ability the client has to improve their score. So it might say plus 50, it might say plus 20, whatever it may be. So that tells us that we know this client has the ability to get this credit score up, should it be able to go up high enough to either get him into a different tier for the cost of the mortgage insurance or interest rates. So we have what's called a what if simulator. So we can run scenarios to say, okay, if we want to get this credit score now to 740 from 700, and it shows us on our report that it has the ability to do that, we go in and do this what if simulator. It will then tell us what it's taking for them to be able to improve that credit score by 40 points. It could be paying off debt. It could be paying off a collection. Getting collections deleted is going to always be the best scenario. So especially if they have medical collections, that would be a conversation I would have with them, as medical collections are the easiest thing, relatively speaking, to get removed from a credit report. So negotiating and working with the collection agency to try and get that removed. We will then help educate them in what documents we need from them to get from the creditor in order for us to be able to do what's called a rapid rescore. So let's say it's paying off the credit card, paying it down, it's getting a collection paid. Then we're going to tell them, here's the documentation we need, send it to us. And as soon as you send it to us, then we can send it into our credit company, who then reaches out to the credit bureaus, gets it updated in their system, and then regenerates a new report with a new score. That can be relatively quick, can take 7 to 10 days based on however long it takes them to get the documentation to us from the creditor. So again, that's what we do, not just in situations of divorce, but any client that we have. If we see that their credit score can be improved and it's going to help the financial situation for them, then we're going to go over that with them. There are times where it's only a 60 or 70% chance of it improving, then we're not going to have them go through that with the chance that we kind of put them through the ringer of things to do and then it doesn't work out. So most of the time it'll tell us what the percentage is, the odds of it going up to that credit score as well. And then we'll go over that with the client. So again, just making sure that we're helping everyone, all of our clients understand just how important credit is. Anyone have any questions on that or anything relative to that? Do you have any credit resources for repair? I have one company I've used in the past, but I haven't used them in quite a while. Fortunately, most of the time, it's either we have the ability, based on what I was just describing, to tell them, here's what you can do to get the credit score up, or the other reason we usually see is just time, because sometimes you don't have enough credit history, so you need to get another credit card, and it could take you 3 to 6 months for that to be able to register and really improve the score. It also might be late payments that have occurred in the past 12 months that are too significant that we need more time to pass before those late payments have less impact on the score and the ability to get a mortgage. So I don't use credit repair companies too often. And I do have one I think I've used in the past, and that was successful in getting some things removed for a borrower. So I can try to find them if you want to reach out to me and send you that information. Anyone else have any other questions? All right, funds for a down payment. This is just talking about, again, when we have clients that are looking at through the divorce situation, purchasing a new home, what can they use? Because that's a common question I have is what am I able to use for down payments? So obviously funds they have saved or investments, if they're going to liquidate, any stocks or mutual funds they do have the ability to retire, borrow from retirement plans. The good thing with retirement, 401ks, it usually has to be with your current employer. The plan that you have with them, you can borrow from it when you're purchasing a home, tax-free and penalty-free. So it's usually a loan that you're taking out against your own funds. You're paying yourself back. It's usually at a lower interest rate, a pretty reasonable, good interest rate, but it allows them to be able to access those funds potentially. Gifts, obviously you're allowed to have friends and family, provide a gift funds. Depends on the loan program, if it's only family or friends are allowed to. Most of them are family. But again, there's a process. There's a gift letter that we have them fill out, and then we document the funds coming to the borrower, and we talk the client through how to make that happen. Also, if they're selling their marital home, obviously those funds are going to be available. And what all we're gonna look for there is a copy of the closing disclosure. And if one spouse is buying out the other and we're helping the spouse that got bought out and is getting the funds from that refinance, basically to pay off that spouse, we need something like either it'd be the agreement that shows that's the money, because the other spouse may not want to give like the closing disclosure and give up all that information. So we should be able to have a separation agreement that shows the figure that's supposed to be paid to the spouse and then show that spouse receiving it. We can use those funds for a new purchase as well. So again, we're going to help everyone that we can to walk through each scenario they have to make it work for them. So there's, flexibility in most things we do.
Question.
That's all I have.
I got a question.
Yeah.
If they're trying to sell the home and the home is not at market value, it's kind of underwater or something, is that a reason, is that a justifiable short sale in some cases?
I don't believe so. No, like, when you look at like short sale waiting periods for Fannie Mae and Freddie Mac or FHA, it says due to extending waiting circumstances, divorce is not one of those.
Okay.
Going to be death, loss of job, something that's out of their control, unfortunately.
Okay.
But yeah, so unfortunately that is not
Right.
a valid circumstance in their eyes. Who pays for repairs required by the lender? Well, that again is talking about, goes back to what we were talking about before, is having that conversation about who's going to be paying those expenses, because normally it's the seller, obviously. That's a conversation you want to have with your clients when they're going through this situation so that everyone's on the same page of what that might look like. Angie asked me what states am I licensed in. I am licensed in Maryland, Virginia, DC, Delaware, North Carolina, and Florida. And then my company is licensed in many other states. So I can always refer somebody if you need anybody in somewhere else.
Hi, Jolene. My name is Sonal Goda. I had a question.
Sure.
I'm working with someone who's been working on a separation through, I forget what it's called, a mediator, I guess. And it's not finalized yet. Based on what you said about the child support and alimony counting after 6 months of receiving it, I mean, it almost seems like it would be better for him to buy like before, because if that income doesn't count, like it seems like he can't buy right as soon as or that income won't count until if he buys right after the divorce is finalized.
Yeah, I mean, unfortunately, the child, if they need child support or the alimony to count, to be used towards purchasing the home, they do have to, like I said, have 6 months that they've been receiving it in order for us to use it. Depending on their age, there's other ways for us to calculate income. Meaning like if they're of retirement age and they have 401k, we can do what's called asset depletion, which means that we take their assets and there's a calculation that we do that could give them monthly income. There's like, I also just did one with outside, it wasn't a Fannie and Freddie loan. It was a unique investor we have that had basically we used 50% of their assets and that gave us their monthly income and we didn't use any other income. So there's, other scenarios that we can look at depending on the whole picture and whether or not it would work. But traditionally for a Fannie and Freddie loan, you do have to receive the alimony or child support for 6 months in order for us to use it.
Okay. And then also, I think they have this thing where, because his wife was actually the primary earner. And so I think they have it set up where she's paying something and then he has to pay something to her too. Like they're like there's child support and or alimony like going both ways in different amounts. So it sounds like maybe the one that he's paying would count against him, but the one that she's paying would not count for him.
Unfortunately, not right away. You're right.
Yeah.
It's the worst of that situation where yes, any debts that he's paying is going to be counted as a debt right away. Whereas any income that he's receiving, he has to show that he's been receiving it for 6 months.
Okay, so the last question, if they don't have everything finalized, is there any issue with going ahead? Like, because he's getting help from his parents too. I mean, is there any issue with him just buying his place?
Well, and that goes back to, so another thing I'll point out there is like when you're talking about parents, that's something else that's come up to me often is when I have a client that comes to me that's going through a divorce, we talk about having another party co-sign to help them qualify, you know, if we don't have the alimony or child support yet, or whatever it may be, they're just got back into the workforce or whatever the situation is. I've definitely had that conversation many times about having a co-signer. Again, it can be a short-term thing. They could look at refinancing down the road to take them off. It goes back to what the question I had earlier is whether or not you should buy when you don't have an agreement. I would say to recommend to have your client talk to an attorney just to make sure that they're not putting themselves in any position that's going to impact the divorce in any negative way, meaning like the marital property and all that kind of stuff. But if they're not using marital funds to purchase the home, and like you said, they're getting assistance from a family, I think there's a good chance that they'll be okay to be able to purchase before everything's finalized. But I would definitely have them talk to an attorney just to make sure.
Okay, all right, thank you.
Sure. All right, let me see if there's any other questions. On Track Credit Path has some good things to help recruit. Yeah, and that's the thing is that I've seen so many clients that have come to me regarding credit repair that they are part of this credit repair program. They paid a lot of money towards it and has had no impact positively to them. So I just hate to see that, but I'm sure there's some good ones out there. So if you have experience with On Track that's been good, that's great. I just haven't had a lot of positive experience on my end in that regard. All right, anyone else have anything else? Well, thank you guys so much. I appreciate you taking the time today on a Wednesday. Like I said, if you're interested in coming to our lunch and learn tomorrow, let me know and we can send you the e-vite for that. And hopefully you found this helpful. And if you have any questions, always feel free to reach out.
Thank you. That was a great.
Okay, all right, thank you.
Thanks, everybody.
Okay,
Bye.
bye.